Jefferies is sticking to its reduced overweight on the Asia-Pacific region, leaving Japan aside. But the global brokerage house, which comes out with its famous Greed and Fear report, seems to be more optimistic about India. Devina is here to take us through the details. Devina, I think it came out over the weekend. What has stood out in the report?
Well, they talk much about what the budget did and didn't do, and also the fact, there are bits and pieces about the coronavirus and focus more on India as well. So they've primarily maintained their reduced overweight rating on India in the Asia-Pacific ex-Japan portfolio that they have. They've spoken about how there is a possibility that the gloom that we're seeing in terms of the economic indicators seems to be a bit more overdone this time around. So talking about that, they talk about the latest Indian PMI data numbers which came out. I think moved in month from January from 52 earlier to about 55.3, which is an 8-year high. So that's nothing to scoff at. The other thing is the services PMI data, which was also at a 7-year high at 55.5. So there are some green shoots that they are seeing over some economic data points that have been coming out. However, it was a big anticlimax budget for them. A lot that was expected not just from foreign institutional investors but domestic investors as well was not met. The report suggests that the government has shown no appetite for bailouts that would undoubtedly please the stock market. And this is in particular to the Indian TARP that was expected to come out. That was in some shape and form to make sure that credit demand picks up, but that did not come about. Aside from that, no detail on how to address the 1,500 stock projects within the real estate space. They had announced that alternate fund of about 25,000 crores, but Greed and Fear believes that even SBI Ventures, which is handling this particular AIF, is not the right choice for doing this. So they were disappointed on the back of that. No help was given to the struggling auto sector, where motor vehicle sales have been down 14% year on year in 2019 itself. And they put in a small line from Rajan Vadera saying that this was definitely not a budget that the auto sector was wanting, but it was doled out to them. Need to see some concrete action that will trigger revival in credit demand. That is something that most of the foreign investors are watching out for. Aside from that, the fact that they've removed the deductibility of insurance, in the new tax regime, that was a big disappointing. And in the report they call it Murphy's Law or Sod's Law, because just in September 2019 they added 2 stocks from the Indian insurance play, that is SBI Life and HDFC Life, in their portfolio. So if something has to go wrong, it will go wrong at some point. So that's something that they talk about. But they still believe that the Indian insurance companies have a big long-term growth prospect within the Asia basket. So that is something that they're still positive on. And obviously, they talk about the government's incompetency in this case, because on one hand they're talking about bringing out the LIC IPO, and then they've removed deductibility. But however, they do believe that majority of the Indian, it's still more financially prudent for them to go ahead and take those deductions. Aside from that, they also talk about the economic risks that the economy still is at a risk of the negative ripple effects from the NBFC crisis. The credit flow continues to remain weak, and that needs to be revived. For total NBFC and housing finance companies, loan growth has slumped from 26% year on year in FY18 to just 7% year on year in Q2 of FY19. Indian TARP was needed for the revival in demand. However, bank credit growth has also slowed from 15.1% year on year in December 2018 to 7.2% in mid of January. But the only silver lining you can see from this is that there's no additional demand for credit, because deposit growths are also rising. So there's no pressure in the banking system because the credit is not flowing. And finally, the government has shown relative lack of urgency on economic policies, which was a big drag for them.
Yeah, well, talk about timing, right? You get insurance in the model portfolio and then this happens. But I think the statement from HDFC Life was encouraging yesterday. They spoke about how sub 1% impact on EVs or VNB as a result of this new move. So,
and they told us also, right? Their
interaction
exposure to specifically these deductions are not all that high that come for them.
Yeah, I think ICICI Prudential is probably the largest one. But very interesting note, Devina. Thanks so much for putting that into perspective.